Hello everyone, I'm Travis Chingo with Ooh La La Moolah and Chachingo Wealth Solutions. I want to show you a few options trades that I did over the past couple of months. Now for those of you that are new to options, you've probably heard before, options are risky. Well, if you don't know what you're doing, they definitely are risky. But if you know what you're doing, they're actually less risky than just buying stocks and mutual funds. Those of you that have experience with the stock market and experience with trading and experience with options know that the stock market moves within ranges of prices. Let me show you what I mean. I'm going to go ahead and bring up a chart here. So this is a chart of the Dow Jones Industrial Average. And this is a 5-year chart. Let me go ahead and expand this so you can see it better. And you can see the date up here in the upper left-hand corner. So this chart goes from January of 2011 to January of 2016. And as you can see, the Dow Jones moved within a range and broke out of the range here, and then it got right back into that range. And then it stayed within this range all through this time. And it stays within this range and just keeps moving within this range. And it broke out of the range here for a small period of time and got right back into that range. So yes, the Dow Jones from 2011 to 2016 went up, but it went up within ranges along the way. And for those of us that understand and are experienced with standard deviation and expected market maker moves, we know what those ranges are at any given time. And we know the ranges that the market stays in 68% of the time, and we know the ranges that the market stays in 95% of the time, and so on. And with options, there are strategies that you can use to take advantage of knowing what those trading ranges are. For those of you that have never seen options before, let me visually explain this so you're not completely lost. I'll go back to the risk profile to help illustrate this. And let's use a stock that everybody's familiar with, Apple. The current stock price of Apple is $97.13. And let's say as an example, we know that Apple has a 68% chance of staying between $80 a share and $110 a share in the next 45 days. So we can sell a put option that expires in 45 days at $80. And as long as Apple stays above $80 per share by the time the option expires, we make money. If it falls below 80 by expiration, we lose money. Now, if we just sell a put, we have unlimited risk all the way down to zero, which means we can lose a lot of money. And each option contract represents 100 shares, typically, so our risk is $80 times 100, or $8,000 for one option contract. But if we buy a put at $75 on top of it, now we've capped our risk, and we can't lose more than 80 minus 75, which is 5 times 100, or $500 per option contract. So by buying a put for protection, our risk is $500 instead of $8,000. This strategy is called a bull put spread. Bull because we profit if Apple goes up, or in this case, stays above $80 per share. We can also sell a call option that expires in the next 45 days at $110 per share. And as long as Apple stays below $110 by the time the option expires, we make money. If it rises above $110 by expiration, we lose money. And again, if we just sell a call, we have unlimited risk, this time to infinity. But if we buy a call at $115 on top of it, now we've capped our risk, and we can't lose more then 115 minus 110, 5, again, the width of the spread, times 100 shares per option contract, or once again, $500 per option contract. This strategy is called a bear call spread. Bear because we profit if Apple goes down, or in this case, stays below $110 per share. Now, if we have both of these on at the same time, this is called an Iron Condor. And as long as Apple stays between $80 and $110 by the time the option expires, we make money. And in this example, we know that there's a 68% chance that Apple will stay between 80 and 110 in the next 45 days. And because the price of a stock cannot be in two places at once, that means our maximum loss in this example is $500. But because we can't lose $500 to the upside and lose $500 to the downside at the same time. That also means that each side of the position has an 84% chance of making money. So let me ask you, if you have $500 to invest in the stock market, are you going to invest it in a stock or mutual fund that can only go in one direction, up, for you to make money, which means you only have a 50% chance of making money? Or are you going to invest it in something like this, where you have an 84% chance of making money? Which brings me back to a point I made earlier. What's more risky, options or buying stocks and mutual funds? Well, if one of them only gives you a 50% chance of making money, and the other, used properly, gives you an 84% chance of making money, it's kind of a no-brainer. And if you buy stocks and mutual funds, you only make money if they go up. Here, you make money if it goes up, if it goes down, or if it doesn't go anywhere and the price stays the same. As long as it doesn't go up too high or go down too low, we make money. And those lower percentages of times that it does go too high or too low, we can make adjustments to these positions that allow us to minimize losses or even still profit on the position. Okay, so let me show you a few real-world examples. The first example is a position I did in IWM, which is the iShares Russell 2000 ETF, which is an ETF that tracks with the Russell 2000 index. And now this is a daily chart, so each of these bars represents one day. For those of you that have never seen a stock chart before, the green bars mean that it went up that day, the red bars mean that it went down that day. And you can see the date there at the bottom. So this is November 17th. On November 17th, I sold a bear call spread on IWM. And I'll show you the transaction here. And I'll zoom in on this so you can see it a little better. So you can see here on November 17th at 12:15 in IWM, I sold two 121 calls. That's what that negative means they were sold. And then I bought two 124 calls for protection. And you can see the price of the two 121 calls was 58 cents, and the price of the two 124 calls was 18 cents. Now, this is the price per share, and each option contract represents 100 shares. So, the 121 calls I sold for 58 cents per share times 100 shares per option contract times two option contracts for a total of $116. And then I bought the 124 calls for 18 cents per share times 100 shares per option contract times two option contracts for $36, which means I received a total credit of $80 to enter this position. And the width of the spread is $3, 121 to 124. So that's my risk, $3 per share times 100 shares per option contract times 2 option contracts, or $600. So my risk on this position is $600. All right, let me go ahead and put that on the chart. So here on November 17th, move this over. $121. And we'll do this. Okay. So we sold the calls here. We sold the 121 calls and bought the 124 calls for protection. So now, as long as IWM stays below 121 by the time this option expires, I make money. Let's see what happened. So it started going up, and then here on November 19th, I sold a Bull Put Spread. And I'll show you that. And zoom in here. So on November 19th, in IWM, sold a 108 put for 70 cents, and then bought a 105 put for 42 cents, and then also sold another 108 put for 70 cents, and bought another 105 put for 41 cents. So that's 70 cents per share on the 108 puts times 100 shares per option contract times 2 contracts, or $140, minus 42 cents for one of the 105 puts times 100 shares and 41 cents per share times 100 shares for the other contract, which means I received a total credit of $57 on this trade. So let's put that on here. The 108 put and there's where we entered our Bull Put Spread. And let me also go ahead and put in the amounts on here so we don't lose track of those either. So the calls, we received a credit of $80 total. And on the Bull Put, we received a credit of $57 total. Okay. So now on the Bull Put, as long as IWM stays above $108 by the time the option expires, I make money. And now, if it stays above 108 and below 121, make money on both sides. So let's continue. You can see it started rising up. We're at November 27th there. And then it started coming back down. Actually, here on December 2nd, because it was up that high, I went ahead and took some profits on the Bull Put. So you can see here, let me zoom in a little bit. On December 2nd, bought one to close IWM 108 put for 14 cents. And again, that's 14 cents per share times 100 shares. And I only did this on one of the contracts. So I still have the other 108 put, but paid $14 here to take off some of the risk and take some profits. So we'll put that on the chart as well. And here on the 108 put, and here we paid $14. Okay. And then let's continue. You can see that it started going back down. Here on December 8th, I took some profits on the call side. I'll show you that transaction. So here, December 8th, bought one to close IWM 121 call for 8 cents. 8 cents per share times 100 shares and only one contract, so I paid $8. And let's go ahead and put that on the chart. And we'll note the price we paid there. So again, paid $8. And let's move on. Then here on the 10th, I took off the other call to take profit and remove the risk. You can see here, December 10th, bought one to close IWM 121 call for 5 cents. So we'll mark that on here. Exited the call. Paid $5. And we will end this here on December 10th. And now we are out of the call side on the options that we sold. But I still had the 124 calls that I bought. The reason being for that, if IWM all of a sudden shoots up and shoots above this 124 level, I make money on those 124 calls. And as you can see, it dropped back down, then started coming back up. Let's see where we're at here. This is December 17th. Staying down there, starting to rise back up. Oh, went too far. On December 22nd here, I went ahead and took profits and closed out the put side. And you can see that here on December 22nd, bought one to close IWM 108 put for 4 cents. So we'll mark that on the chart. And we'll end this on December 22nd. And we will mark on there. We paid $4 to exit that option. And again, that was I only sold the 108 puts, or bought back the 108 puts here, closed those out. I still had the 105 puts, so in case IWM shot down, I could still make money on those options that I bought for my protection. And then we continue on, and this option expired on December 24th, so this was the end of the trade. So as you can see, it did exactly what we needed it to do. It stayed within this range. And let's go ahead and pull up the results here. So IWM, our total profit, and we'll just go right along the lines here. So we received a credit for $80, then we paid $8, then we paid $5, then we received a credit on the bottom for $57, we paid $14, and we paid $4. So a total profit of $106 on this trade. And the margin, or what we risked, what the amount of capital that we risked on this trade, again, was $600. So we had a return of 17.67% on this trade. And that is IWM. Okay. So now let me bring up the next one, which is QQQ. QQQ is the ETF that tracks with the NASDAQ. So we are here on November 13th, and on November 13th, I entered a bull put spread on QQQ. You can see November 13th, QQQ sold 2 104 puts for 77 cents, bought 2 101 puts for protection for 46 cents. So again, that is 70 cents per share times 100 shares per option contract times 2 contracts minus 46 cents per share times 100 shares per option contract times 2 contracts. So received a total credit of $62 to put on this trade. Move that back over here. Alright, so let's put that on our chart. So the 104 put, 104, this is where we entered our position and received a total credit of $62. Okay, so now, as long as QQQ stays above 104 by the time this option expires, we make money. So let's see what happened. Started going up. I went too far again. And here on November 16th, I entered the call side and entered a bear put, or I'm sorry, a bear call. So again, November 16th on QQQ, sold 2 of the 116 calls for 38 cents and bought 2 119 calls for 7 cents. So that is 38 cents per share times 100 shares times 2 contracts minus 7 cents per share times 100 shares times 2 contracts. Again, received a total credit of $62 on this bear call spread. Okay. So we'll put that on our chart. Again, that was the 116 call. $116. We entered the position here. And received a total credit of $62. So now, as long as QQQ stays below $116 and stays above $104 by the time these options expire, I make money. So let's continue. It started rising up. And I think back here, this is November 25th, and so this is November 27th. And on November 27th, I took profit on the put side because it was so high here. So zooming in, November 27th, bought one to close QQQ 104 put for 15 cents. So right here, took some profits. And paid $14. Or I'm sorry, $15. Okay. And let's go on. And here on December 2nd, you can see it got really close and it almost touched our 116 call. And here I went ahead and made an adjustment in case it did continue to move higher. So I'll show you that here. The adjustment on December 2nd bought one to close QQQ 116 call for $1.13. So we'll put that on the chart. We made an adjustment and we paid $113. Okay, so now with this adjustment, I have one 116 call that I sold and two of the 119 calls. So the idea is if QQQ does continue to rise, I will make more money on the protection calls that I purchased than I will lose on this remaining 116 call that I have. So I want QQQ to continue to rise at this point after making this adjustment. If QQQ reverses and comes back down, then I just lost that money that I paid to make that adjustment. So let's see what happened. And it came back down, shot right back up, and then started coming down again. And here on December 7th, I went ahead and exited the put side because it was still high enough up here. I took profits on that and took my risk off on the put side. Let me show you that. So on December 7th, bought one to close QQQ 104 put for 5 cents. So we'll throw that on the chart. This is where we close out the position. And that was on December 7th. So at this point, we have no risk to the downside. In fact, if QQQ does shoot back down and goes far enough, we can still make profits on the protected puts that were purchased. Oh, and let me mark on there. That we paid 5 cents for that, or $5. So paid $5. And let's see how the rest of this played out. And as you can see, started coming back down pretty significantly. Here on December 14th, I went ahead and closed out the other 116 call and took profits on that. And here's that transaction. December 14th, bought one to close QQQ 116 call for 5 cents. So we exited the position. There we go. This was on December 14th. And now we have no more risk to the upside. And here we paid $5. I'm going to go on December 18th. And here this line marks where the option expired. So it came back down here in the middle, and this is where the option expired. So as you can see, the QQQ also played out exactly as we needed it to. However, because it got as high as it did here, I went ahead and made the adjustment just in case it went ahead and kept rising. So I actually lost out on this trade because the adjustment didn't pan out. So let's see. Let's document the results here. So again, going across the top, we received a $62 credit. Then we paid $113, then paid $5, and across the bottom, received $62, paid $15, paid $5. So lost a total of $14 on this trade. So that's QQQ, lost 14. Again, the margin was 600. Our maximum possible loss was $600 because we had a $3 wide spread on both sides. And we lost 2.33% on the trade. Okay. So that was QQQ. The last one I want to show you is a position that I did in DIA, also known as the Diamonds, which is the ETF that tracks the Dow Jones Industrial. Okay, so we are here on December 3rd, and on December 3rd, I entered a bull put spread. December 3rd on the Diamonds DIA. sold 2 166 puts for 119, and bought 2 163 puts for protection for 87 cents. So that's $1.19 times 100 shares times 2 contracts minus 87 cents times 100 shares times 2 contracts. Received a total credit of $64 on this trade. And again, it's a $3 wide spread, which means our max risk is $300 per contract. We did 2 contracts. Maximum possible loss is $600. Our risk is $600 on this trade. All right, so that is the 163 put. $163. We entered the trade and received a total credit of $64. Credit $64. So now, as long as DIA stays above 163, or I'm sorry, I did this at 166. 163 was the protection. And I'll redo that there. So 166. So now as long as the DIA stays above 166, I make money. So let's see what happened. Next day it went up, and on December 4th, I went ahead and entered the call side and entered into a bear call spread. And you can see here, December 4th, sold 2 183 calls for 57 cents, bought 2 186 calls for 16 cents. So 57 cents times 100 shares times 2 contracts minus 16 cents times 100 shares times 2 contracts, received a total credit of $82. And that was at the 183 strike. 183. Entered the bear call. Oops. And received $82. Credit equals 82. Okay. So now I want diamonds, the DIA, to stay above 166 and stay below 183. Let's see what happened. It's staying down, but staying within this range. And this is December 17th. Here on December 18th, had a pretty big move down these past couple of days, so I went ahead and I took profits on the call side. And I'll show you that. And on the same day, December 18th, I actually closed out both of the 183 calls. So at 9:30 in the morning, bought one to close DIA 183 call for 14 cents. And then at 3:20, bought one to close DIA 183 call for 5 cents. So paid a total of 19 cents or $19. So mark on here, got out of the position. This was on December 18th. We're no longer in the call side on the 183 calls. And we paid a total of $19. So now at this point, if DIA shoots back up and goes above, we have no risk here because we closed out the 183 calls. We still have the 186 calls on, so if it does shoot back up, we can still make even more profit on those 186 calls. So let's see what happened. Started rising back up, and this is through Christmas time, which the market typically does rise slowly during the Christmas holiday. And then this was December 30th. So here is New Year's Eve. Started coming back down. And came way down after the first of the year, January 4th. And as we advance this, we see we plummeted. And we broke through our 166 call. And unfortunately, for this demo account, I didn't pay as much attention to it because I was managing my real money trades. So I left this on, and then you can see January 8th came down again, and we're well below our 166 call. So I went ahead and made the adjustment on these positions here. And here's what I did. So on December 8th, I bought one and sold one to close 166 put, 163 put. So I closed out one full spread for a total debit of $1.38. Then I also closed out the other 166 put for $3.15. So that means $1.38 plus $3.15 times 100 shares means I paid a total of $453 to make this adjustment. So I'll mark that on the chart. We are now out of the 166 puts. And this was on January 8th. Okay, so now we have no more risk. Oh, let me put this on here. That paid $453. So now we have no risk to the upside, no risk to the downside, and I left one of the 163 puts on. So that way, if it kept going down, I could make a profit on the 163 call or 163 put that I still had on. So let's see how this played out. It's still down there, started coming back up, shot way down, and this was here on January 13th. Went up a little bit on January 14th, gapped way down here on January 15th, and this is where I went ahead and sold that 163 call. Or that 163 put, I'm sorry. So you can see here, January 15th, sold one to close 163 put for $385. So mark that on here, that we received a credit of $385 for that 163 put. And that is also the day that the option expired. Let me move this over a little bit. so we can see that. Okay. So let's see what the results are here. Across the top, we received a credit of $82. Then we paid $19. On the bottom, we received $64, paid $453, then received $385 for a total profit of $59 on this position. So diamond, $59 profit. Our risk was $600. So we made a 9.83% return on this position, which is pretty significant. As you can see, even though the trade went against us, we still made a profit because we made that adjustment. I'll bring this back, and I want to bring these results back up here and show you. So across all three of these positions, we made a total return of 8.39%. Our total risk was $1,800. We had three positions that had a $600 risk on them. We profited a total of $151 over a span of 2 months. So we had a return of 8.39%. Now, you might be looking at this and say, well, Travis, you made $151 in 2 months. Big whoop. That's nothing. But that's an 8.39% return in 2 months. Any financial advisor will tell you that they target 8% return a year. And here we did it in 2 months. Now, we can do these over and over again, and we do these 45-day trades. There's 8 45-day periods in a year, so we can do these trades 8 times a year, which means our annualized return is 67%. That's a significant return, 67% a year. And let me show you how significant that really is. I'm going to bring over a compound interest calculator here from investor.gov. So we have this $1,800 that we started with, not even adding any more capital, any more investments to this. After 5 years, at a 67% interest rate, and compounding this 8 times a year, because we can do these positions 8 times a year, after 5 years, be close to $45,000. Your $1,800 would be worth $45,000 in just 5 years. Well, what would it be after 6 years? Not 56. After 6 years, it's worth $85,000. How about 7 years? 7 years, your $1,800 is worth $163,000. What about 8 years? After 8 years, your one-time $1,800 investment over and over again, 8 times a year, would be worth over $300,000. Now I got your attention. How much would it be after that nice even 10 years? $1.12 million. That's right, I'm telling you that a one-time $1,800 investment over and over again with these positions after 10 years would be worth $1.12 million. So if you like making money, if you're into that sort of thing, I encourage you to check out my options training website, tradeoptionsbetter.com. I have a few training courses on there right now, with many more to come in the future. So please check that out. I thank you for watching this. I hope you learned something, and happy trading.